Imagine, just for a second, unlocking hidden chambers within the IRS instructions. Seriously, each one potentially holding hundreds, maybe even thousands of dollars that could flow right back into your family's budget. We're talking about real, legitimate tax savings here. Savings that honestly a lot of people either overlook or maybe just don't fully grasp, leaving serious money on the table. Today, think of us as your guides. We're venturing deep into the 2024 IRS instructions for Schedule 8812. Consider this your personalized map right to decode the child tax credit, the additional child tax credit, and the credit for other dependents. Our mission, it's simple. Distill the most important, the most actionable knowledge so you can confidently grab these valuable opportunities and make sure you claim every single dollar you're entitled to.
That's exactly right. Look, these aren't just, dry tax codes buried in some manual. They are actual direct pathways to real financial relief for families like yours. We're going to break down the specific criteria, walk you through the latest changes for 2024, and, crucially, highlight those little details, the ones people often miss. Details that can honestly make a dramatic difference to your tax refund or, how much tax you owe. By the end of this, you'll be well-informed, you'll be ready, and you'll understand the nuances that really impact your bottom line.
Okay, so let's unpack this. This financial treasure map, as you called it, we're zeroing in on Schedule 8812. That's Schedule 8812, Form 1040, credits for qualifying children and other dependents. Think of this form as like the main hub, the control center for figuring out three really powerful tax credits designed specifically for families. First, the big one, the child tax credit. We'll probably call it the CTC.
Yep, CTC.
Then there's its sibling, maybe even more powerful in some ways, the additional child tax credit, or ACTC.
The ACTC, right.
And finally, the credit for other dependents. We'll shorten that to ODC. Schedule 8812 is meant to bring clarity, guide you step by step, so you know exactly what you might be eligible for. It's really the key.
And what's really interesting, I think, is how these credits are designed. They're meant to support a whole range of family structures, different income levels, offering targeted relief where it's most needed. And for 2024, there's a pretty significant update, something you really need to pay attention to. The maximum amount for the additional child tax credit, the ACTC, it's gone up.
But really, how much?
It's now up to $1,700 per qualifying child.
$1,700.
Wow. And look, that isn't just a small tweak. For a lot of families, that translates directly into hundreds, maybe thousands more in their refund. It's a real tangible boost to the household budget. It reflects this ongoing effort, to provide more support given today's economy. This increase, it can genuinely make a difference in your financial planning.
Okay, so $1,700 per child for the ACTC. Let's break that down. What does that really mean for you, the listener, especially if you're hoping for a bigger refund? You mentioned its power. It's not just a deduction, right? Which just lowers your taxable income.
Exactly. It's a direct credit.
Explain that difference because it's huge.
It is huge. Okay, think of your tax liability, the amount you owe the IRS, as a bill. Many tax credits are non-refundable. They're like a coupon. They can reduce your bill, maybe even down to zero. But if your bill is already zero or the coupon is worth more than the bill, you don't get cash back from that coupon. You just owe nothing.
Right, the credit just disappears if there's no tax to offset.
Precisely. But the ACTC, it's refundable. Think of it like that coupon plus a gift card. If your tax bill hits zero and you still have ACTC credit left over, the IRS actually sends you the remaining amount as a refund. It's cash, money back in your pocket, even if you didn't owe any tax in the first place.
That is a game changer, truly money back. But okay, before we get too carried away picturing that refund hitting the bank account, we absolutely have to talk about timing. This is crucial. What's the deal with the delay if you claim the ACTC?
Yes. This catches people out all the time. It's a really important point for planning your finances. If you claim the additional child tax credit, the law actually prevents the IRS from issuing your entire refund.
But the whole thing, not just the ACTC part.
The entire thing, every single dollar. They cannot issue it before mid-February 2025. This isn't just a delay on the ACTC portion. It holds up everything. Any other credits, any overpayment, it all waits.
Why do they do that?
It's primarily an anti-fraud measure to give them time to verify claims properly, especially because the ACTC is refundable. Makes sense, really. So while you're getting this significant benefit, you absolutely need to factor in this timing. If you're counting on that refund, say, for a big purchase in January or paying off holiday bills, you'll need to adjust your expectations. A lot of people actually use it like a forced savings account, knowing it'll land mid-Feb. It's pretty consistent year to year.
Okay, good to know. Definitely something to plan around. Now, just to keep things clear as we go deeper, we'll be using some abbreviations, the same ones the IRS uses. So ACTC is Additional Child Tax Credit. ODC is credit for other dependents. CTC is Child Tax Credit, easy enough. And then TIN's taxpayer identification numbers. Those are critical. We'll mention SSN for Social Security number, ITN for Individual Taxpayer Identification Number, and ATN for Adoption Taxpayer Identification Number.
Yep, getting comfortable with those acronyms will definitely help as we get into the nitty-gritty.
All right, let's move into segment 2. The gateway to credits those taxpayer identification numbers, PINs.
Okay, so if we connect this back,
Hmm.
really the absolute foundational step, the first hurdle for claiming any of these credits, CTC, ODC, ACTC, it all hinges on having the correct taxpayer identification number, the TIN,
Right, for everyone involved.
for everyone.
Okay.
And not just having one, it needs to be issued by the due date of your tax return. That includes any extensions you file for. This applies across the board to you, the taxpayer, to your spouse if you're filing jointly, and critically to each and every single person you claim as a qualifying child or dependent for these specific credits.
So it's like the entry ticket. No TIN, no credit.
Pretty much. Think of the TIN as the IRS's way of verifying identity. It ensures the claim is valid. Without a valid, timely TIN for each person, the IRS will just disallow that credit. Flat out. It's non-negotiable. And honestly, it's where a surprising number of legitimate claims fail, just due to an oversight on the TIN.
Makes sense. Identity verification is key. But here's where I think it gets really specific and maybe trips people up. For the child tax credit, the CTC, and the additional child tax credit, the ACTC, each qualifying child needs what the IRS calls a required SSN. What exactly does that mean? A required SSN? Is it just any Social Security number?
That's a great question, and you're right to pick up on that nuance. It is the sticking point for many. For the CTC and ACTC, a required SSN means two things. One, it must be valid for employment in the U.S., and two, it must have been issued before the due date of your tax return, including extensions.
Valid for employment.
Yeah.
Okay, so not just any SSN.
Correct. This is a strict rule. The thinking behind it is that these credits are aimed at supporting children who are sort of established parts of the U.S. system, which an employment valid SSN helps confirm. So if a child has, say, an ITN or maybe an SSN card that specifically says not valid for employment or valid for work only with DHS authorization, then unfortunately you cannot claim the CTC or ACTC for that child, full stop.
Even if you get the right SSN later and amend the return? Nope. Even if you amend, the IRS is incredibly clear here. The required SSN must exist by the tax deadline. It's a key identifier specifically for these credits. Understanding that difference is vital. It's a common mistake that can cost families thousands. Get that required SSN sorted early if you plan on claiming these.
That's really clear and, yeah, pretty strict. But I remember reading there's a specific, quite sad exception to that rule for infants who pass away. And then what about the ODC? Is there more flexibility there if a child doesn't have that specific required SSN?
Yes, there is a very specific and frankly compassionate exception to the SSN rule. If your qualifying child was born and tragically passed away during 2024 and you weren't able to get an SSN for them, you can still claim them for the CTC or ACTC.
How do you do that? You'll need to attach documentation to your return. A copy of their birth certificate or death certificate or hospital records. The key thing is the document must show the child was born alive. It acknowledges a terribly difficult situation and provides a path for the credit. Now, regarding flexibility, if a child doesn't have that required SSN for the CTC, KCC, maybe they have an ITN, or maybe they're just too old, over 16. But they do have another valid TIN, like an ITI or an ATIN issued by the tax deadline. They might still qualify you for the credit for other dependents, the ODC.
Ah, okay, so there's potentially another path there.
Exactly. It shows that while the rules are strict for the main child credits, there's nuance. There are alternative ways to get some tax relief for dependents who don't fit that specific CTC mold but are still your responsibility. It's a key difference between the credits and offers important flexibility.
That's incredibly helpful. That distinction is crucial. So for the credit for other dependents, the ODC, it sounds like TIN rules are, yeah, definitely more flexible. ITINs and ATTs are okay. This must be really important for families with dependents who aren't citizens or permanent residents. What exactly does a dependent need for the ODC? And what if you've, applied for an ITIN, but it hasn't actually arrived by tax day?
Precisely. For the ODC, the TNN rules are more accommodating. Any dependent you claim for this credit needs either an SSN, an ITN, or an A10. And like before, it must have been issued on or before the due date of your return, including extensions. But here's the really good news, the bit that often eases anxiety. If you apply for an ITN or an ATN for that dependent by the tax deadline,
Just apply. You don't need it in hand.
just apply by the deadline. So usually April 15th, 2025, or later if you get an extension. If you apply by then and the IRS subsequently issues the number based on that application, they consider it as issued on time for claiming the ODC.
Oh, that's huge. That takes pressure off waiting for the IRS processing.
It really does. It's vital for planning, especially if you have dependents like, say, relatives visiting long-term or students who meet the other dependency rules but aren't citizens. It means the process just needs to be started by the deadline. It's a practical rule that stops people missing out just because of processing delays they can't control.
Okay, segment 3. We've nailed down the ID numbers, the TINs. Now let's pivot to the who.
Yeah.
Who actually qualifies? This is where we piece it all together. Let's start with the child tax credit and the additional child tax credit. The CTC and ACTC. These are often top of mind, and they have very specific conditions, right?
They do. For the CTC and ACTC, the conditions are like a strict checklist you have to go down. First, the obvious one, the person must be your dependent. Now, that sounds simple, but it ties back to all the general dependency tests in the main Form 1040 instructions, the section called Who Qualifies as Your Dependent.
Right. Those cover relationship, residency, support.
Exactly. Relationship tests, they generally have to be your child, stepchild, foster child, sibling, step-sibling, or descendant of any of them. Age tests, which we'll get to in a second, it's specific for these credits. Residency tests, they must live with you for more than half the year. There are exceptions, of course, for temporary absences like school or illness. Support tests, you generally must provide more than half of their total support for the year. And the joint return test, the dependent usually can't file a joint return with someone else unless it's only to claim a refund of tax withheld. So they have to pass all those general tests first.
Okay, so that's the baseline dependency. What's next for CTC-TC specifically?
Second, and this is the big one for these credits, the qualifying child must be under age 17 at the end of 2024. That means December 31st, 2024. They have to be 16 years old or younger on that specific date.
Under 17. Not through 17, but under 17.
Precisely. It's a very firm cutoff. And yeah, it trips people up constantly. Let's use that example again. Your child's 17th birthday is December 30th, 2024. Even if they meet every single other dependency rule, citizen, lives with you, you support them, you cannot claim the CTC or ACTC for them for 2024 because on December 31st, they were 17, not under 17. It's a hard line. Knowing that exact age at year end is crucial.
Definitely a critical detail.
Okay.
What about adopted children? Any complexities there for CTC, CTC? How does the IRS view them?
That's a really important question, and thankfully the IRS simplifies this quite a bit. An adopted child is always treated as your own child for these credits, period. And that includes a child who has been lawfully placed with you for legal adoption, even if the adoption isn't technically final by December 31st.
Oh, good. So the placement itself is key.
Yes. It ensures adoptive parents get the same treatment as biological parents, assuming all the other criteria, age, dependency tests, the required SSN are met. It removes a potential layer of confusion. Now, if your child, whether biological or adopted, hits age 17 or is older at the end of 2024, that's when you shift your focus. You start looking at the credit for other dependents, the ODC, because they've aged out of the CTC-CTC.
Right, which leads us perfectly to the ODC. The credit for other dependents. It seems like it catches dependents who don't fit the CTC-CTC mold. Maybe older kids, other relatives. It sounds more flexible on TINs and age, but you mentioned it has its own unique rules too. What are the specific criteria for the ODC?
You're exactly right. The ODC is designed for those dependents who don't qualify you for CTC or ACTC, but you're still supporting them. First condition, same baseline. They must be claimed as your dependent on your return. They have to pass those general dependency tests we talked about, relationship, residency, support, etc. But here's a very specific requirement for the ODC, different from the CTC-CTC focus. The dependent must have been a U.S. citizen, a U.S. national, or a U.S. resident alien.
Ah, so a citizenship or residency test for the dependent themselves.
Correct. This applies directly to the person you're claiming for the ODC. It's a strict requirement for this credit. Let's paint a picture. Say your nephew, who is 10 years old, lives with you all year. You provide all his support. He definitely qualifies as your dependent under the general rules. However, if he lives, say, in Mexico, and he's not a U.S. citizen, not a U.S. national, and not a U.S. resident alien, then you cannot claim the ODC for him even though he's your dependent.
Wow, okay. So that citizenship residency status is a major hurdle for the ODC specifically.
It is. It's often overlooked. It means the ODC is generally for dependents who have that formal connection to the U.S. citizenship or residency status. This could be your 18-year-old child, your elderly parent living with you, maybe another relative, or even a non-relative who lives with you all year and meets the dependency tests, provided they also meet this citizenship residency requirement.
Okay, that clarifies the ODC rules nicely. It really highlights the differences.
Yeah.
Now, this brings up a really important question. I bet a lot of listeners are thinking this. Can you claim both? If a dependent somehow seems to fit both categories or there's overlap, can you claim both CTC and ODC for the same person? Or maybe pick the one that gives you more money?
No, absolutely not. Unequivocally, you cannot use the same person to claim both the child tax credit, or ACTC, and the credit for other dependents. It is strictly one or the other.
Okay, mutually exclusive.
Completely. The IRS instructions are crystal clear. When you fill out your Form 1040, 1040 SR, or 1040 NR in the dependents section, for each person you list, there's a column 4. You have to check either the child tax credit box or the credit for other dependents box. You never check both for the same individual.
So it's not just about preventing double dipping.
It's more fundamental than that. It reflects who each credit is intended for. The CTC-CTC is targeted at younger children with that required employment-valid SSN, specific family support goals there. The ODC is the broader category for dependents who are older or maybe don't have the right SSN or don't meet the specific CTC criteria but still represent a financial burden and meet the ODC's own rules, like that citizenship residency test. Understanding that intent helps you correctly categorize. You choose the credit the dependent qualifies for based on the rules we've discussed.
Yeah.
Usually, if they qualify for CTC-CTC, that's the one you'd claim as it's generally more valuable.
Got it. Choose the right box based on the specific rules for that person. All right, segment 4. Let's talk about the fine print. Income limits and some special situations. Of course, with valuable credits like these, there are almost always income limitations. The government wants to target these benefits. So how do your earnings affect how much CTC or ODC you can actually claim? Are there specific phase-out points we need to know?
Yes, absolutely. Income limits are definitely a key factor. They act as a gatekeeper. The maximum amount of your combined CTC and ODC can be reduced. It can phase out if your modified adjusted gross income, or MGI, goes above certain levels.
Modified AGI, is that different from regular AGI?
It can be, slightly. For most people, it's very close or identical to their regular adjusted gross income from their Form 1040. But for this calculation, certain things might be added back, like specific foreign earned income exclusions. The instructions have the exact definition. The thresholds themselves are pretty high. For folks who are married filing jointly, the limit is $400,000 of MGI.
Sure, $100,000.
For everyone else, single, head of household, married filing separately, the limit is $200,000. If your MGI goes above those amounts, your total credit starts to decrease. For every $1,000 or part of $1,000 your income is over the threshold, the credit is reduced by $50. It gradually phases out.
Okay, so higher income earners might get a reduced credit or none at all.
Well,
What about the interaction with your actual tax liability? You mentioned non-refundable credits earlier.
right. This is where that refundable versus non-refundable distinction really matters again. Let's say you calculate your potential CTC and ODC. Those parts are mostly non-refundable. If your actual tax liability, the tax you owe before these credits, say on line 18 of Form 1040, is less than the amount of your non-refundable credits, well, you can only use those credits to bring your tax liability down to zero. You can't get the excess back from the non-refundable part.
So if you owe $500 in tax, but calculate $2,000 in non-refundable credits, you only benefit from $500 of it.
Essentially, yes, for the purely non-refundable portion, your tax becomes zero. But this is exactly where the additional child tax credit, the ACTC, comes into play again. Because the ACTC is refundable, you might still be able to get a significant portion, up to that $1,700 per child we mentioned for 2024, paid out to you as a refund, even if your tax liability was already zero or reduced to zero by other credits.
So the ACTC calculation happens separately and can give you money back regardless of your initial tax bill.
Correct. That's its power, especially for lower and middle income families who might not owe much or any income tax.
It's a vital distinction. Okay, digging into the ACTC specifically, it seems to rely heavily on something called earned income. This sounds like it could get complicated, especially for, say, gig workers or self-employed
Mm.
people. What exactly is earned income for the ACTC, and who really needs to pay close attention here?
Earned income is absolutely crucial for calculating the ACTC amount, particularly if you have low tax liability but you've been working. Generally, earned income includes things you work for, wages, salaries, tips, net earnings from self-employment.
So income from your job or your own business.
Right. If you run your own business, work freelance, drive for a rideshare, your net profit from that work is generally earned income. The IRS instructions actually provide a specific earned income chart and an earned income worksheet to help you figure this out accurately. These are really helpful if you have more complex situations, maybe multiple jobs, or if you're also claiming the earned income credit, as the definitions can interact.
Are there any unusual things included or excluded?
Yes, a couple important ones. One fascinating inclusion is non-taxable combat pay.
Non-taxable combat pay counts as earned income.
For calculating the ACTC, yes. Service members can elect to include it. This can significantly boost their ACTC amount, even if their regular taxable income is low due to deployment. It's a specific benefit for military families. On the flip side, income that's excluded because of a tax treaty, that's not included as earned income here, and things like unemployment benefits, Social Security payments, pensions, interest, dividends, those generally do not count as earned income for the ACTC. It has to be income from working. Using those worksheets is really key to getting the earned income figure right, because errors there directly impact your potential ACTC refund.
Very helpful. Okay, what about residents of Puerto Rico? You mentioned they might have a different situation. How does it work for them with these credits, especially ACTC?
Yes, bona fide residents of Puerto Rico have some unique rules. They can be eligible to claim the ACTC if they have at least one qualifying child. Interestingly, they might be able to claim it directly on Form 1040-SS, which is the U.S. self-employment tax return often used in territories. They might use that instead of the standard Form 104-01040-SR and Schedule 8812, especially if they don't otherwise have a requirement to file a full 1040.
So a different form pathway, potentially.
Potentially, but here's a key detail. If they do figure their ACTC using Schedule 8812, maybe because they're filing a 1040 for other reasons, they should only include earned income that would normally be reported on a Form 1040 or 1040-SR. This specifically excludes any income they earned in Puerto Rico that is exempt from U.S. income tax.
Ah, so they don't count their Puerto Rico source exempt income in the ACTC calculation.
Correct. It avoids a sort of double benefit. It recognizes their unique tax status, but keeps the ACTC calculation based on income subject to or related to the U.S. system. It just highlights how complex tax law gets across different jurisdictions, even within U.S. territories. Careful attention needed there.
Absolutely. Now, this next point you brought up earlier feels incredibly important, almost like a benefit shield. You mentioned ACTC refunds won't affect certain welfare benefits. Why is this provision so critical? What does it really mean for families relying on assistance programs?
This isn't just interesting, it's a fundamental protection. It's designed specifically to ensure that families receiving vital government support aren't accidentally penalized or pushed into a worse situation just because they claimed a tax credit they're entitled to. The rule is clear. Any refund you receive from the additional child tax credit cannot be counted as income when federal programs are determining your eligibility or calculating your benefit amounts.
Which programs are we talking about?
Major federal safety net programs. Things like TANF, Temporary Assistance for Needy Families, Medicaid, SSI, Supplemental Security Income, and SNP, the Supplemental Nutrition Assistance Program, often called food stamps. Receiving your ACTC refund will not reduce your benefits from these programs. It won't kick you off them.
That must be a huge relief for many families.
But it is, and there's more. It also can't be counted as a resource like savings in the bank for at least 12 months after you receive it. This gives families time to actually use the money for necessities or save it without immediately jeopardizing their eligibility for ongoing support based on asset limits. It provides a really significant safety net. It ensures that ACTC genuinely helps improve a family's financial situation rather than just shifting money around between different support systems or creating new problems. It lets a credit be a true lifeline.
That's fantastic. A really thoughtful piece of policy design. Okay, segment 5. Let's talk about actually calculating this stuff and avoiding problems. The IRS instructions mention several worksheets. Credit limit worksheet A, worksheet B, the earned income worksheet, even an additional Medicare tax and RRTA tax worksheet. Honestly, just hearing those names sounds a bit intimidating, like you need an accounting degree. We don't need to go line by line, obviously, but what's the main point of these worksheets? What should listeners understand about their role without getting bogged down?
Yeah, the names can sound daunting, I get that. But think of them as the behind-the-scenes engines. Their main purpose isn't to confuse you. It's to ensure accuracy and guide you to the correct credit amount, especially if your situation isn't perfectly straightforward. They're like the IRS's built-in calculators and logic checks. For example, Credit Limit Worksheet A. Its job is to make sure your non-refundable credits, like the main CTC and ODC, don't add up to more than your actual tax liability. It stops you claiming a credit against tax you don't owe. And then it might point you to Worksheet B if you have other credits, like the mortgage interest credit or the adoption credit. Worksheet B helps figure out the right order to apply all these different credits and limitations.
Okay, so they manage the interactions between different credits and your tax liability.
Exactly. And the Earned Income Worksheet, that's critical for the ACTC. It precisely defines and calculates your earned income, factoring in self-employment, statutory employee income, all those details we discussed. It makes sure the refundable part is calculated correctly. The additional Medicare tax RRTA-1, that comes into play if you paid those specific taxes, ensuring they're factored correctly, particularly for the ACTC calculation. The key takeaway isn't the line numbers, but that these worksheets integrate information from all over your tax returns, Schedule 1, Schedule 2, Schedule 3. They prevent common errors. Honestly, good tax software handles these calculations automatically, which is why using software is often recommended. But understanding their purpose helps you know why the numbers come out the way they do. Don't fear them, they ensure accuracy.
Right, they're tools for accuracy. Good way to think about it. Now, this whole deep dive is focused on getting these valuable savings. That's the goal. But we have to talk about the flip side. What happens if someone makes an improper claim? If they get it wrong, deliberately or accidentally? The consequences can be pretty serious, right?
Oh, absolutely. This brings us to due diligence and the potential penalties. The IRS is extremely strict here, and understandably so, given these credits involve significant amounts of money, especially the refundable ACTC. If you claim the CTC, ACTC, or ODC incorrectly, erroneously, and the IRS later decides your error was due to reckless or intentional disregard of the rules.
What does that mean exactly? Reckless or intentional disregard?
It means you either didn't make a reasonable effort to understand the rules or you knew the rules and chose to ignore them. It's more than just an honest mistake. If they determine that, you will be barred from claiming any of these 3 credits, CTC, ACTC, and ODC, for 2 years.
2 years. Even if you genuinely qualify in those later years.
Even if you would otherwise be eligible, it's a 2-year ban, and it gets worse. If the IRS determines the error was due to fraud, that disallowance period jumps to 10 years.
9 years. Wow.
10 years. Plus, you could face other substantial monetary penalties on top of losing the credits. It really underscores how critical it is to understand the rules and follow the instructions carefully. The consequences of getting it wrong, especially if it looks intentional or reckless, are severe and long-lasting. It's not just losing the credit for 1 year, it can impact your family's finances for a decade.
That is a very stark warning. Get it right, be careful, do your due diligence. But let's say someone did mess up in the past. Maybe their credit was denied, perhaps because of an error or because the IRS thought they disregarded the rules. Is there a way back? If that disallowance period is over, can they claim the credit again? Or is it a permanent black mark?
No, it's not necessarily permanent, but you do have to take a specific proactive step to reclaim eligibility. If your CTC, ACTC, or ODC was denied or reduced for any tax year after 2015, and the reason wasn't just a simple math mistake or a clerical error by the IRS. So if it was disallowed because the IRS believed you didn't meet the actual eligibility rules, then generally you must attach Form 8862 to your tax return the next time you want to claim that credit.
Form 8862, what does that do?
It's called Information to Claim Certain Credits After Disallowance. It's basically your formal statement to the IRS, signed under penalty of perjury, explaining why you now qualify for the credit. You have to provide information showing that whatever caused the previous disallowance has been corrected or no longer applies. It demonstrates you understand the rules now and meet them. Unless a rare exception applies, you need this form attached to your 1040 to get the credit approved after a prior disallowance. It's the official way to get back in the IRS's good graces for these specific credits.
Okay, so Form 8862 is the key to reclaiming eligibility after a denial. Good to know.
Precisely.
All right, let's wrap this up. To recap our deep dive today, the child tax credit, CTC, the additional child tax credit, ACTC, and the credit for other dependents, ODC. These are genuinely significant opportunities for tax savings. We're talking potentially up to $1,700 per qualifying child just from the ACTC, directly back in your pocket for 2024. The absolute critical elements we covered. First, making sure everyone, you, your spouse, your dependents, has the correct taxpayer ID number, the right TIN, issued on time, especially that required SSN for the CTC-KTC. Second, really understanding the specific age limits under 17 for CTC-KTC and the residency or citizenship requirements, particularly for the ODC. Third, being aware of those income limitations, the MGI thresholds, $400 locays married, $200 others, where the credits start to phase out. And finally, carefully navigating the calculations, especially for that powerful refundable ACTC, which uses earned income and can give you money back even if you are no tax. This deep dive into Schedule 8812 really shows there's a lot of detail, but also a lot of potential value in understanding these rules. It's not just paperwork. It's about claiming what's rightfully yours.
It really does. I mean, look at just one schedule. Schedule 8812 reveals the incredible intricacy involved in securing these credits. You see it in the nuances of earned income definitions, the precise meaning of a qualifying child, those crucial protections for welfare benefits. It all points to a system that's trying to provide very targeted support. But, and this is the key, it only works if you, the taxpayer, understand the rules and apply them correctly. For you, the listener, having this knowledge, it's not just about filing taxes smoothly. It's really about empowering yourself, making informed decisions that directly impact your family's financial well-being, ensuring you claim the support you are legally entitled to receive, which, it raises a final thought, maybe a question for you to ponder. What other details, maybe seemingly small things, buried in other parts of the vast IRS tax code? What other often overlooked instructions might be hiding valuable financial opportunities for your family, just waiting to be uncovered? There's always more to learn, always potentially more to gain if you dig a little deeper.